Hello and welcome. You're watching Business Today. I'm Sakshi Batra. Well, inflation, that is what got everybody worried, from consumers to government to also investors now, as it is slowly but surely eating into our returns. But are there really ways to protect your hard-earned wealth and your investment returns from inflation's negative effects? Well, that's going to be the focus of our discussion today. Joining in is a very, very special guest with me on this edition, Mr. Tarun Birani. He's the founder and CEO at TBNG Capital Advisors. He joins in to share some insights on what is the best way you and I can make inflation-proof portfolios as well. Thank you very much, Mr. Birani, for taking the time out. Appreciate you really joining in.
Thank you. Thank you, Sakshi, for calling us.
As an investor, could you help us understand how does one really calculate the impact of rising inflation on our investments?
So, impact on our investments. Before that, you need to understand inflation is going to affect my earnings, my potential spendings going forward. So, from that in itself is a business for a lot of companies. And in turn, if you are an equity investors, your investments, the risk zone increases dramatically in an environment where inflation keep rising in a very uncontrolled manner. So as we are seeing a lot of volatility in the equity markets, we are observing in few months post this Russia-Ukraine war going on. And due to that, a lot of prices have gone uncontrolled manner. We have seen the prices rising. So due to that, most of the asset classes, the risk assets, particularly risk assets, have taken a beating in the market. If I talk about risk or the beta assets, you have small cap funds, mid cap funds, let's say some specialty fund like a fund which invest into high risk sectors. All those are places where the investments have been impacted, but at the same time it benefits also some companies, let's say companies which have a good pricing power and the demand destruction doesn't happen. For them, actually this inflationary environment could be a very good environment. So definitely it impacts the investments a lot. The debt investments, when we are talking about debt investments, the fixed deposits rates are going to go higher going forward, because we are clearly see a sign where the general rate interest rate environment is going on an upward trajectory. So it is maybe 6 months, 1 year down the line, it is going to be good for small savers. The money which they used to put in small saving scheme, fixed deposit, they are going to earn more than what they are earning right now. Debt mutual funds, currently there are a lot of volatility. You are seeing a heightened interest rate. So all the duration oriented strategies have taken a beating in last 3 to 6 months, because we are seeing with the increase in the interest rates, all those funds have gone down. So one need to be cautious right now, because the volatility is going to continue for going forward in next 6 months also. So the duration oriented strategy, one need to be careful. Commodity assets like gold and everything could be good assets where one can put some money for the protection purpose. So, and I just tried to give you an overview of various asset classes in this environment.
So let's take these asset classes one by one to help all our viewers understand how should they proceed in a higher inflationary scenario to all these asset classes. Let's first of all talk about equities. You did point out how some of the higher risk stocks or higher risk funds, they could be impacted more in this kind of a volatile scenario. So could you help us understand the relationship of inflation and higher interest rates with equities?
What will be my likely defense if my fixed income is going to give me 7.5-8%, and my expectations from a high risk assets like equity for next 1.5 year is 10%? So naturally the investor tilt will move more towards a fixed income asset. I'm just trying to give it in a layman language. So my investor behavior, my behavior in terms of investing will tilt more towards high earning fixed income asset, which has a very low volatility going forward compared to equity, which looks volatile. So, and particularly the high risk equity investments like a small cap investments or specialized sector oriented funds, the risk could be much higher. That is where the investors start shunning out all these high risk assets in this environment, and they start getting into more safer, let's say blue chip, large cap, or industries which are not going to get impacted due to the high inflation. So that would be the larger impact on equity. So it is going to be a volatile phase going forward into equity, and one need to be cautious. But in no way I am saying equity need to be out of the client portfolio, because you need to have a very purpose driven and goal driven approach towards investing. You need to have your asset allocation plan. You need to look at it from a 5 years, 10 years down the line. Just because I'm saying equity looks volatile, you should not take out the money from equity. Yeah.
Okay. So even in a volatile environment, you should continue with your SIPs and your investments into equities. In the longer run time, for sure, it gives higher return. But in a volatile scenario, you should just be cautious about the investments that you make, and perhaps the investors tilt towards safer assets, better than the equities, which provide you lower risk. Say, for example, for FDs, PPFs, and all the other debt investments at this point in time. You pointed out about gold. Gold is usually traditionally seen as an inflation hedge. But I want to ask you, what is the best form of gold that investors should look at in the current scenario, where most of the commodity experts believe that gold prices are going to go higher from here? If one looks at investing in gold, what is the best form?
There are a couple of ways through which you invest in gold. So you can take gold index or ETF funds, which are available with most of the mutual funds currently. Another option is a sovereign gold bond option, which is launched by RBI and Government of India. And there you get paid some interest also on that, particularly some 2.5%, which none of those mutual fund will give you. It has a longer maturity profile. It is not open ended in nature, though it is traded on the
Gold exchanges.
yeah. So you can always trade in that, but it's much for a longer maturity. You get more tax benefit. So from an investment vehicle point of view, I would like sovereign gold bond fund is one of the best option to look at.
Okay, understood that. What are the other investment options that one can explore to beat inflation and the negative impacts of inflation on their investments?
I would say that going forward in next 3 to 6 months, when you see the interest rates have firmed up significantly, at this point of time, I would like to look at long dated PSU bond funds, and that as a category, or government securities also one can look at. So let's say when interest rates move to 7.5% or 25-50 basis point higher from here, we can actually start looking at long dated bond funds, because that has a potential to generate higher alpha. Because the environment, no government or no central bank wants such high interest rates going forward. So it has to come down over a period of time, and that may benefit long term investors into bond. But particularly, this is important to understand that uh, this could be a little volatile journey. Let's say if you get into long dated debt funds, you need to have a 3 to 4 year view to get very good returns on that. Don't take it with a 3 to 6 months view, because that's not tax efficient. Also, from a return perspective, also the journey or the experience may not be great. So that could be one option. One can look at options like InvITs, in investment trust. So you have a power grid InvIT available. There are other InvITs also available. Those assets could also be explored. REITs are also very good options. Real estate investment trust, because in this environment we are seeing the real estate prices are also firming up. With the construction cost going up, you are seeing the general environment in the real estate market is sanguine right now and positive right now. And with the pandemic behind us, business has started up. The rental yields are inching up right now. So you could look at some REITs in India also. There are some REIT funds outside India also available for investors to invest in from India. So one could definitely explore that. Equity, to my mind, at this point of time, one need to have a asset allocation approach, continue to do their long term SIPs, but maybe if you have lump sum money to invest right now, maybe you want to divide that money into longer term. So if you want to invest this money in 6 months, maybe you want to divide that money for 12 months to make sure you get more rupee cost averaging for that.
Okay, understood. So the options are there in front of you. While inflation is high, there are ways to navigate through this high inflation phase and protect the returns that you have on your investments and choose wiser options for yourself and for your portfolio, ranging from PSU bond funds to REITs to investment trusts as well. Those are some of the options that can help you in this high inflationary scenario to balance out the negative impact of inflation on your wealth creation portfolio. So definitely go out and explore these options along with your financial advisor. Thanks a lot, Mr. Birani, for sharing these wonderful insights with all our viewers and helping them understand how to inflation-proof investment portfolios in the current environment.
If you like the video, do like, comment, share and subscribe.